All right, the stock started today on a pretty negative note. It looked like things might be pretty dire after that jobs report. It ended up being pretty strong on a headline basis. I think once you kind of dug into the numbers, wasn't as strong, especially from an inflationary standpoint. As a result, the market took a huge U-turn this morning and actually ended up rallying well above 1% to the upside by the time it was done, closing near the highs of the day. So a big turnaround, closing above Monday's high point. We talked about that earlier this week. So now, of course, as it always is, like when you have one update, everybody turns bullish, and here we go back to 4,800, right? Even Tom Lee was on CNBC. That's when you have an update is when he comes on. And so now the question is that right? Are we going to be back up to 4,800? Was today good enough to actually be trend reversing? So we're going to break it down, take a look at all the signals, take a look at what we've been expecting to see if how much of today has reversed those expectations. Break it all down like we always do, taking a look at some really interesting moves in different asset classes and especially within the different sectors. Not exactly your most risk-off move that we had going into like today. So we'll break all that down to see, okay, how bullish are we now going into a new week? Big week next week, inflation, beginning of earnings season, all of that. And then, of course, our trade idea is a stock that's looking really nice itself, a lot better than what the market is, and we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, October the 6th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live video. I do at 3:30 Eastern times. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click on this thumbs up icon, it opens up this tab, hit that like button. Again, that helps us get our content out to all of our followers. It's a big deal to us. That's why we always ask every day. Our goal is to get to 100 likes on Twitter. We got the 92. That's the closest I've been to 100 in a long time. So thank you to those of you who are liking this day in and day out. And those who aren't, you can do right now while you're watching. Let's see if we can get that up to triple digits. All right, let's get started by taking a look at the S&P 500 with the market forecast indicator. Nice engulfing pattern that we ended up with here today. Starting off the day lower, of course, on the jobs report. And then rallying up above the highs of the whole week, right? So we didn't get above, we actually got above the close. We actually finished the week high. We didn't get above that Friday high point, which you can see was a little bit of a little hill there. But we did get above Monday's high point, which I mentioned in a tweet earlier this week. That we don't do that during the bearish weeks. So that was a good sign. It brought the near-term line up to its highest level since that last bear tag we got over here at the very end of August. So that's a good sign. Not into the reversal zone yet, but again, barring a collapse Monday, which 14, we're going to be going for 14 in a row next Monday. So most likely we're not going to get a collapse on Monday. We're going to get an update, right? You would think. Even if it's a small update that, by what was that, like a tenth of a point or less? So barring that near-term line will get in the reversal zone. The momentum line probably won't. Like if it didn't get up there with this move, it's probably not going to. Unfortunately, we close off of the high by a smidgen. That momentum line is really sensitive, so it's dependent upon where we end up closing. You can see if you get up and close near the high, then you can get to a decent level on that momentum line. Market sentiment does continue lower, and we have dropped into bearish territory. That's typical of correction levels. We'll talk about that more here in just a second. The intermediate line is in the reversal zone. Again, it doesn't stay in the reversal zone for very long when you just get these little pullbacks. It's more typical of corrections when you get down there. We've been down there now for, let's see here, not including this day. So 1, 2, 3, 4, 5, 6, 7, 8, 9 sessions. That's quite a bit, right? You have to go. The nice thing is we have a recent correction to take a look at because we have these. And even in the first part of the correction, you notice we were only down there for a few days, and then one, and then we got close there on that leg lower. Then on this leg lower is where we spent quite a bit of time. and then that one last leg there, and then here we spent a lot of time because that's where we got the cluster of clusters, right, where we typically wash out. So in this particular case, like, that's a long time there for just a normal pullback. So you wouldn't expect that this would be just a normal. It was right here, but then we fail to bounce up. So pullback, fail, pullback, bounce. That's what a correction is. And remember, like I said last week, or at least earlier in the week, and I think maybe in last Friday's video, when you're in a correction, not every day is a down day. I know that's not. I think that's the idea, is that when we are like in bearish mode, we just go down every day. And then when we're in bullish mode, we go up every day, which probably is a lot closer to the truth than the other way around. But when you're in a correction, you don't have every day is a down day. You don't have every week being a down week. You have, that's like I've said before, there's going to be up days. That doesn't necessarily signal the end. But there is going to be an end, and if this is in the end, the end, then that's okay. We have a pretty decent opportunity here for that momentum line, that near-term line, to kind of, they need to get a little bit higher than this to get the intermediate line out, but that's a good start. Looking at the Russell 2000, which has been the weakest, this is the one that has been full-on correction mode. Again, I think I tweeted this out right here. So this is the S&P 500 and the Russell 2000, you'll see in a second, on that last update before we started this correction. So this would be July 31st. The arrow, this little cross right where my cursor is, that is today, or that was yesterday when I tweeted this out. That was where the S&P finished yesterday. So you can see that, that's not that big of a drop on the S&P 500. It stayed above the value area at the time. There's not a lot of volume here, so you can see how easy it was to kind of get to that level. But look at the Russell 2000. Again, that's where we were yesterday. And this is, again, July 31st. So you notice we didn't just drop down to the top of the value area. We dropped down all the way through the value area to the very bottom of the value area. So much different rows. The Russell 2000 has clearly been in a correction, as you can see with all these clusters as well. And it's a good day today. We didn't quite get above this high point. Would be right here is Monday's high point. So we didn't quite get above Monday's high like we did on the S&P. But it's still a good day, and the momentum and near-term line didn't get in the reversal zone, and we've seen they've gotten up here before. It took a 2-day rally. This is a 3-day rally with a long lower shadow on Wednesday. So now the question is whether or not we can follow through on this and rally up and get going here to the upside, kind of fill in that gap there and see if we can't get going. Of course, the NASDAQ 100's the big reason for a lot of the gains. You can see we're already back to light green shading, so we're the intermediate lines above. It's not above the market sentiment yet, but at least it is above, out of the reversal zone, unlike the S&P. Again, you don't have the strong short-term sentiment yet. We did close above Monday's high and last Friday's high, so it's a pretty good close above multiple weeks worth of highs here. Not quite the bear tag yet that would suggest the beginning of a new intermediate rally. So we don't have that yet. But again, if we're going to start a new rally, today can be one of those days. Is that bullish? I don't think we will. So let me just be on the record. I don't think this correction's over with. But because as I've told you before, just because we have an update doesn't mean that we're not in a correction. Corrections have plenty of updays, as I've shown you in prior videos. So they have plenty of up weeks. But we do have to acknowledge the potential, the signals that we see, all right? And this can be a signal that things are starting. Nice, good engulfing pattern on the NASDAQ 100. Let's go back to the S&P and look, since it's Friday, and look at the weekly version of this. And you notice that we did not get the bull tag, so we rallied enough to avoid the bull tag on the S&P 500. Remember, the Russell 2000 didn't get a bull tag either, but we pretty much are in bearish decline. Dark pink shading the red line, intermediate lines cross below market sentiment. So that has done that. The Dow Jones Industrial Average, remember, got a bull tag a couple of weeks ago, last week. Wasn't that big down of a week. And you can see its intermediate line is also crossed below its market sentiment. But the S&P 500's intermediate line has not crossed below market sentiment yet, and again has avoided the bull tag for a week. Now usually, as I mentioned, I think in the last video, when we get the bull tag, we tend to get pretty decent drops to the downside, and so we haven't had a 2% decline yet. Look how everybody cheered today that we had a 1% rally. Now, granted, it was off of a 1% pre-market decline, but we had a 1% rally, and a lot of people cheering that, hey, here we go, right? Well, we've had 4 in a row of 1% declines. Like, it's not surprising to follow up a big decline with a big rally, a big decline with a big. I mean, even in bearish modes, you can see you got plenty of during the correction of 2022. Look at all the here, especially right when it started in January. Look at all the 2% rallies we had in the midst of a correction, right? In the midst of dark pink shading and a red line on the market forecast. So again, a 1% move today doesn't necessarily mean, it's not even the biggest update that we've had here recently, does not necessarily mean that it's over with. So we can't put the banner up, mission accomplished banner up yet. Doesn't mean that that we won't be bullish. I don't think we will be, but it's not one day doesn't get things going. Let's take a look at the other weekly chart that we tend to look at, and that's this one here. We did get a lower low, we got a lower close, but as you notice here, so right now the Hakinyani, we did stay above the 200-week, or the 40-week, exponential moving average here. Remember, the Russell 2000 has gone clearly below its, and it's got the death cross. So Dow Jones has also clearly dropped with a clear lower low, much lower low on the S&P. The NASDAQ 100, on the other hand, not so. I mean, it's actually got a little bit of a transition candle because we got a long upper shadow, higher close, long upper shadow. So a little bit of a transition. So clear different market. We have 2 different markets again. We've seen this story before, where the NASDAQ 100 is showing bullish patterns and it's trying to steer the S&P in its direction. The S&P will probably end up at least starting the week with a transition candle next week. But the Russell and the Dow just clearly are not there yet. So you know, which way is the market going to go? In the direction that's the Russell's been leading it, or is it going to be saved by these mega cap names? That's, hence the Magnificent Seven, right? They ride into town and save the day, and that might be the case this go around. If it's going to be the case, it's going to be the case this go around as well. Obviously, we don't have 3 red arrows anymore in the S&P. We didn't have, we got greens on Wednesday on the NASDAQ. We do still have 3 reds pretty easily, though, on these other 2. Now, we're probably a day away from getting at least a green arrow on the MACD, on the diamonds and on the Russell 2000. But again, it goes to kind of show we don't have 3 red arrows, or 3 green arrows, not even close to having 3 green arrows. And you look at the 2-line version, we didn't even close above the MACD did close above its moving average, but we didn't close above the 17. That's how far away we were from the 17. And that's how big of a move again, it's kind of like, oh, dang, we had this great big move, and it didn't get us above a really important level, considering the bullish on the. Now, can it happen on Monday? 14 Mondays in a row to the upside? Definitely. It can happen on Monday there. Of course, on a weekly basis, we avoided the cluster, so we stayed above the 30. We're actually still above this 62% Fibonacci level. The MACD is actually still positive. Remember how we were talking earlier this week that it was slightly negative? We are clearly in bearish territory on the stochastics. We have some decent volume. So, next week could very well be that week that either we bounce up from here, we get back above these 2 moving averages here. We feel really good about life. You'll see probably multiple appearances of Tom Lee on CNBC, as you saw him today. Every time the market's rallying more than 1% or so, they bring him on. And he did reiterate the same target he had all of last year is the same target he's had all of this year, 4,800 by the end of the year. So he reiterated that target again today. So if we get back above these lines, very good chance that happens. He'll make multiple appearances next week. Or if we continue on this decline, because we're in bearish territory, that we're crossing 0 there. If we get the bull tag next week, and if it ends up being a 3% down week, you will not be seeing very many appearances of Tom Lee. And I think that scenario is probably more likely than the bounce. And again, we need to be watching for that bounce, and that could happen. But I'm still in the camp that we get that 3% decline on a weekly basis that we haven't got. And for that matter, a 2% decline on a daily basis that we still haven't got this entire intermediate pullback. I also remember, too, that we still haven't got the 1.5 times the average volume. We came close. We came close a week ago. We came close today. But we still haven't got the you notice whenever I zoom out here, that you get, these, when you get at the bottom of these declines, you start getting arrows, right? You start getting the 1.5 times the average volume, and we just haven't had that yet, right? I mean, shoot, on the corrections, we get lots of them, and we haven't even gotten one this entire time. So this has nothing to do with like the VIX. This is just volume, and this has nothing to do with like the volume of the S&P, of the ETF. I mean, it's being lower because it has nothing to do with that. Like it's just the average. It's got to be 1.5 times the average, and we haven't had that, right? As among other things that we haven't had. Your DMI is looking better and not back below 25 on the negative. You're not above 20 yet on the positive, but hey, at least you're moving in the right direction. So that's a positive development. IWM, we did get the blue arrow there on the blue line getting below 10. And a little bit of a divergence here. We avoided that cluster on IWM at least. But it's still nowhere near where these lines need to be to change direction. At least, at the very least, on the Russell, the negative indicator is below the 80x. So that's a sign of convergence, right? At least convergence. If we're not consolidating yet, we're at least converging, which means convergence, remember, stays in the direction of the trend. It just does it with far less momentum. So that's one positive for the Russell, that even if it does go down, you won't have the same momentum to the downside. Your RSI is back above 40. Your CCI, remember, it's got to get above positive 100 to change what has been a bearish trend, because we got the correction signal here. This is the correction. We've had 2 weeks now below minus 150. Just getting below minus 100 is a correction signal. We've had 2 weeks below minus 50 now. So we are in correction levels. We haven't dropped below 40 yet on this RSI, so keep that in mind, even though we are in bearish territory. So technically, that signal is suggesting that we are a lot more bearish than we actually are. We still have, we got above the green line, but we're not above the blue. We still have our trend. It's not mature strength anymore, right? We never did get below -5 here, but we are bordering on mature strength. So again, we're not out of the woods yet here. IWM, member, got very strong mature strength, well below -5, easily above 80. We didn't even get above the green line here, and there's a big gap here. So clearly mature bearish trend here. So we're not close to changing this. So we are now, after spending most of the week here outside the Keltner channel, even this morning, we are clearly now not outside the Keltner channel to the low end. And the momentum, which really picked up to the downside here more than what we've seen in a while. And again, just for some context on what that momentum looks like in a correction. So look at all those momentums over there, and you notice a couple of these had yellow bars before it turned red again, right? And we had yellow bars here before it turned red again. Let me zoom in on that so you can kind of see. Just so you know, like, even though we're getting a yellow bar right now, like you can see here, we had a yellow bar. Look at that up day, right? I mean, you could, again, on corrections, you have some really big up days. It got the yellow bars up, and then we just went to a lower low. And over here, you got the yellow bars up on a lot of big up days, 4 in a row before we continued. So again, getting the yellow bar, and you can see a few of them over here as well. Getting the yellow bar doesn't quite mean yet that this bearish move is over. It would be nice to get in that upper half of that Bollinger Band width. A very high Bollinger Band width, no less. I mean, we're at the 150-day highs. We're not at the 52-week highs, but we're at the 150, because that's way up here. But we are at the 150-day highs, because that has gone considerably lower. We're not in the upper half. We're not in the upper quartile. We're not in the upper. We haven't broken above 100 yet. Which, I mean, we did break it below -100, which typically starts these kind of moves. So keep that in mind, that we're actually a lot closer to the start maybe than we are to the beginning. So we haven't had that yet. We did get a nice little. We avoided a new low. That's good, because we don't restart the clock, right? We didn't get a new 4-week low point. We're actually the clock's still ticking to that 6 days, which is now, we're only a few days away from that early next week. We've already hit 0 on the negative. We don't have to hit it again. We've already hit it once. So getting above last week's high point is going to be imperative going into next week. Imperative that we fill in this gap and get up towards 442. Fill in that breakaway gap that we got over here. Because then that kind of nullifies it. Breakaway gaps we don't fill in for a long time, more than just a couple of weeks. So that would kind of nullify that breakaway gap. We still have the runaway gap that started this thing back over here on the 15th. So that would be ideal. The Qs have already filled in that gap. So that 21st gap right here, the Qs have filled that in and then some. The Qs have now gotten into the upper half and into this area, very low volume. So, if the Qs are going to lead us, they're doing it. IWM, on the other hand, if IWM is going to lead us, they're not doing it, right? We're still below last week's low point. We closed below last week's low. We did get above. We did not get above Monday's high. So we will have a lower high, a lower low, and we closed below last week's low, even though we came off the lows. So if the IWM is going to lead us, they're not doing a good job of doing that. But at the very least here, SPY, we did get above last week's low. We got towards last week's high. We got to bust through that sucker. Bust through this thing, get in the upper half of the range next week. If we can get a good breakaway gap. See, that's the other one positive sign is that we gapped down here. Didn't quite hit one standard deviation, became close. And then instead of dropping like all these other gaps, we rallied. So that's a good sign. Now we need to get a good gap higher of, 0.2% to get that one standard deviation, and then don't fill it in at all, run away, and then we start, right? That's how you typically start a runaway move, an intermediate move to the upside. So if we can get that, we can get some good volume. Today's range was above average. 10.5 points. I mean, that's a huge range there. 10.5 points on the daily range. The volume was 113 million. So when you look at those two numbers in context, 10.5 points is way out of the park here. So, again, and 113 million is way up here. So both these lines are rising, not bullish, right? So, but it's okay. You're going to start bullish moves with bigger moves. It would be nice if we were already at 1.5% by the time it started. And we just haven't. And it would also have been nice if we got today's move after the VIX, got above 20 or above 100%. And we got above 20, we didn't stay there. We got above 100 on the VVIX, obviously didn't stay there. We got above the 200-day moving average on the VIX. It didn't last very long. So it didn't last very long here. But we're still above like the 17. The MACD is turning down. So, if we start to turn back down, it would have been nicer had we had a little bit more of a washout. We clearly have not gotten a washout move. Not at all. I mean, as I mentioned to you before, I've shown you this chart before, but when you are in intermediate decline, you easily get above 100%, and we just haven't. Like in March, we didn't, but at least we got a lot closer than this go around. But all the others, even 2019, you get above 100%. You typically hit 105 before they kind of wash out that pullback. We haven't gotten that here. So we barely got above 20, didn't last, not even on a closing basis there. We're still back in neutral levels, though we have kind of broken out. So now the question is, after the breakout and a little bit of a return move, is this the extent of the return move and we continue with the breakout, or are we going to get back below these old highs, right? Your typical kind of support and resistance analysis there. All right, if you take a look at what's driving this price action, you can see the three-headed monster still over the last 3 months. The dollar, commodities, yields are all still up, even though commodities are well off their highs. Yields are not off their highs. The TLT is at its lows of the 3 months, and the dollar is close to its highs of the past 3 months, despite a little bit of a move here today. But let's look at just today. Let's look at the reaction here to this jobs number that we had today, the reversal. Now, you won't see most of the reversal because it happened overnight, but you can see where the lows started. The yields were way up to start the morning. TLT was way down there. TLT actually finished the day kind of at its midpoint of its daily range, so it hardly rebounded, not nearly to the extent that equities did. Real estate obviously rebounded as well, but ended up being relatively lower. High yield outpaced a lot of these treasuries. That's a big deal because that had been breaking down. And you can see the Qs, IWM is actually outperforming the Qs earlier today, but then the Qs just took off versus IWM. So when you look at the difference here, the ratio of IWM relative here to, pull this up here. the ratio of the Qs relative to IWM, we actually did close at a new high. Like, I mean, look at that. That's a tremendous move. If you look at the whole week, if I were to zoom out this entire week to the beginning of this week, I mean, check this out. Look, IWM's down 2% on the week. Like, I mean, and it was down 3%, right? So we talk about getting a 3% move. IWM did get that, and we still finished down 2. But the Qs finished up 2% for the week mainly because of today's rally. But we were pretty flat going into it. We were up multiple times. We were up on Wednesday. We were up on Monday. We were up on Wednesday. We were up on Thursday. And then we just finished up today. So, I mean, a big move higher. And yields still finished pretty much near the lows of their week. Commodities really came down hard. These last 3 days, look at commodities. I mean, they started the week off negative anyway. But the last 3 days, big drop down to the downside there. And you can see the dollar was bullish for most of the week. Still stayed flat by the end. I mean, that's a tremendous move on the Qs, and you can see what it's done here. Like I said, big time move to the upside. Closing at the highest level of this cycle. Still very extreme. You know, you can see the long-term PPO still very high. We're still kind of diverging here, and look at your correlation. We did finish about 40 or 70, in the RSI. The correlation's deeply negative. I mean, that's going to turn around. That correlation doesn't typically stay negative, especially with the market rising. And if you look at, like, I mentioned high yield versus the Treasury. It's Treasury comparable for its duration. Remember how I said earlier in the week that it was breaking down. You can see here, like, it did bounce back up today. It's still at bearish levels, right? We're still breaking down, but at least we kind of bounced back up out of bearish levels for the RSI. The MACD is still pretty clearly negative. The long term is still falling pretty easy. So at least we had a 1-day reprieve. This is a big issue. So we were actually up at 51 today earlier. So we came back at the end of the day, but we had some really good, like, you can see when you get these big spikes in breadth, this is the number of stocks above the 50-day moving average, they typically coincide with the index crossing above its moving average there. You can see it there, you can see it here on this one, you can see over here multiple, these two right here, both big moves, albeit coming from low levels, but still big moves crossing the moving average. We got a big move today. It wasn't as big as it was by the end of the day, but it was still a big move today, and we did not cross it. In fact, we're still, like, not even really close to the moving average. So kind of like as we saw over here, when we're like, okay, we're crossed above the moving average, but we weren't getting, like, big moves. We got bullish moves, but nothing major. And same thing on this one too. We crossed above the moving average, but not with a really major move. It would have been great had we crossed above that 116. We just didn't. The highest we got was in the 90s that I saw. And that just doesn't get it. That doesn't cut it, right? It doesn't get it done, and so that's a problem from a breadth standpoint. Your new highs and new lows did rally back up yesterday, which is crazy. But today, considering how bullish we were today, it came back down. And it came back down to minus 620. So, like, we were way up here in the minus, like, 135, minus 153. So I got the numbers right, just reversed order. We got the minus 153 yesterday and new highs and new lows, right back down to minus 600 today. So again, it goes to show that today's rally wasn't as broad as we would like to see. Your McClellan oscillator did turn up, right? It did look better, but it didn't get above zero. It ended up being at minus 21. We're clearly below minus 500. So again, we're lacking the breadth because what we saw, where the bulk of this is coming from, is those Magnificent Seven, and you see it in the sector comparisons too. When you look at, how the week went here. Let's see, what was the beginning of the week? It'd be nice to go straight to October. If you look at this week, I mean, XLK, XLC, and XLY didn't even join the party. It was just XLK and XLC. Those two are heavily weighted towards the few issues in the Magnificent Seven in there. And then you had weakness in staples and utilities, which is not the areas that you typically want to be weak in. That's not normal for a safety trade, right? For a risk of, for a decline, for a move to the downside. And of course, we know that they've been really lagging behind, mainly because of the rise in yields, right? When you look at, you can see the 10-year yield really started to take off on May 12th. That's when it really took off and started this intermediate run that we've been on. Well, if I go back to the sector rotation, back to, well, here it is, May 12th. I still have it up here. Look at the three, since the, I mean, again, that's, yields have gone up. How much? How much has the yield gone up here? Oops, not that chart, this one. So we were at 3.39, we're at 4.78, so about 140 basis points. And obviously we're off of, I mean, we've gotten up to 150 basis points rally. So during that 150 basis point rally, your big winners have been XLC, XLK, and XLY. Right? That's not what you would expect during a 150 basis point rally. Remember, we're supposed to be tightening conditions, and yet this chart looks like the S&P has just killed it. I mean, the S&P is up 4%, and it was up at one point in time over 10%. But during the rally, like, this was supposed to tighten financial conditions with these rides. Remember the Fed, President Daly from San Francisco saying the market's doing the work for the Fed. This is not the market doing the work for the Fed. You don't want to see during a 150 basis point rally, and that's since May. So there was one rate hike in this on July 26th was the last rate hike. So there was one, the market did move up 25 basis points. So the 10-year yield has gone up 150 basis points. The Fed raised short-term rates 25, and you've had this reaction. That's not financial conditions tightening. Staples down 13%, utilities down 16%. I mean, these are all areas that have heavier debt loads generally. And of course, also their main attribute that people invest in these companies are for their dividend yields. And they're not very attractive right now relative to the 10-year yield, which is looking very attractive if you're looking for that income payment with safety on your principal there. Of course, the other thing we kind of look at there too, when you're talking about safety on your principal, is the skew. The skew is still down. So again, when we really bounce up, the skew bounces back up and gets back above its moving average and takes off. That's kind of the confirmation that we have indeed bounced. The skew went down today. I mean, it's still, and it's barely down. It's like below 130. That's this would be by far the highest level. If you go back to all the other corrections that we've had, so let me zoom out here and we'll go to a weekly. If you go to all the corrections that we've had, like there's a correction there's a correction in 2018 right here, there's the COVID correction, we dropped below 120 on the skew. 15 and 16 we dropped over here below 120 again. Again, this would be the lowest drop for a correction that we've seen. Obviously, you can tell too. Like, look how big these declines were, and this would be all that we've had This would be the smallest, right? The smallest correction decline. Again, we haven't got that bull tag, so technically we're not. But when you look at like the zigzag here, this is the intermediate pullback levels, 7.8%. The Russell, on the other hand, this is correction levels, 13, almost 14%. That is correction levels. We did correct there. We have correction here. This is more than just a pullback. That's why the Russell just can't get going. Look at this range it's been in for the last year, right? After having a range in 21, then we're in correction. But look at that move. It's like it cannot get going. Not like the NASDAQ 100 at all. There's no range this calendar year on the NASDAQ 100. It's way up here. And you've had, again, just little pullbacks, but nothing too, if I were to change this to 10%, we still haven't got, that's not that big. We haven't even dropped 10% yet, which, again, it's not typical. I mean, you typically can get 10% declines on this typical intermediate pullbacks, and we haven't on this go around. So it goes to show just again how weak this pullback has been, and how we just haven't really washed out yet at all. All right, that brings me to our trade of the day today. I want to take a look at Amgen. So Amgen hasn't really had a pullback, right? It's had a bull tag, multiples, but the last bull tag we bounced, and this one, as of right now, kind of looks like we're bouncing too. We had a really good update today. The near-term line crossing above, not in the upper reversal zone yet. It was actually a lot closer at the end of the day, but But at least it did cross its intermediate line. Last time we crossed the intermediate line over here, you can see that's when we bounced up, and we got a good little rally going here for however long it's been going. So that's a good opportunity that you see here. If I take a look at the weekly crossover on Amgen, you can see we have been bullish. We got a little transition, so and you can see a strong PPO. And you look at this transition, you think, okay, are we gonna if it's a bearish candle, if the actual candle is bearish, then a good chance that we reverse. Actual candle's not bearish, so a good chance that we don't reverse. Good chance that we actually probably get, like we did over here, maybe another transition or two, and then we just keep going back up. So keep that in mind in terms of what Amgen's looking like. We obviously have one green arrow on here, and you can see the other two are looking pretty good, especially when you look at it on the 2-line version. You can see a little bit easier. You can see that MACD and stochastics appear to be kind of like the MACD histogram's turning up already. It wasn't very big of a momentum decline. We held the 30. We're back above the 8-day moving average today. Pretty decent volume down there. From the DMI, you can see we had a nice little bounce up here too. The ADX is still above 20. The positive's not above 25, but it's still above the negative. Negative is falling. Looking at the RSI and the CCI, they're not at bullish levels, but they're not in bearish either, right? We're still easily in the upper half. We didn't, we hit minus 100. We're coming off of it. We obviously did not break down below minus 100 on the weekly. Looking at the Ichimoku cloud, you can see that it's a weak trend, but it's still positive. We're still back above the green line. We still have a positive rate of change above the cloud. So it's still, really good bullish from chart from that perspective. And you can take a look at the Bollinger Bands too in the upper half, like above the value area, the upper half of the band width. The bands are inside the Keltners, but, and you got some weak momentum with these red dots, but we'll see if we turn back around here as we're back in the upper half, right? And actually we're, getting close to being back in the upper quartile again, which would go a long way towards pushing it back up, especially considering, again, the trend and still being above the value area there. So what I decided to do was to come over here and do a bull put spread. So not the strongest directional trade, but a relatively weak directional trade. It's a higher probability, so there's risk involved. I'll be putting, the full $1,000 of risk to get, what do we end up getting here? Let me go, not beta weighted. And let's change it to... There we go. So we're $400 for that $1,000 of risk. So there's we're taking a little bit of risk to get that, but there's high probability associated with that, and you can see that break even is below these lows. So as long as we stay above these lows and we continue this little bounce, then we're okay. But if we break through to new 4-week lows, then we're going to take that ideally no more than that $400 loss. Even though we are positioned for a $1,000 loss, we don't want to take more than what we're trying to get, because we can replicate. If we do take the loss here, we can get it back on another trade with a max gain. We can't, it will take multiple max gains if we let it go all the way to the 1,000. So we try to limit what we're trying to lose on these higher probability trades to the amount that we're trying to equal the amount that we're trying to make. That it makes it easier to make it up that way. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, and we'll see everybody next week.